Okay, Assalamualaikum. Okay, we stop the part 1 in this slide, which I said before that there are few factors that will we consider as complicated factors that deal with the capital budgeting. Among them is the risk associated with the future cash flow, which can be divided into 3: political risk, economic risk, and the financial risk. Okay, so what is the political risk? The political risk we are talking about, for example, the parent company is in Malaysia. Okay, so Malaysia we call it as a home country. Then we also have the subsidiary, and our subsidiary is located in different foreign countries. For example, in China. So China we call as a host country. So any political event that occurred in China will affect the cash flow of the subsidiary, our subsidiary just now, okay, to the parent company. So among extreme form of political risk is the nationalization or expropriation of asset. This means sometimes the country can seize the asset either with or without compensation. Okay, so this is among the risks that this one is uncontrollable. The parent company cannot control because this depends on the political event of the host country. Another one is changes in foreign exchange control. Okay, repatriation restriction. So repatriation restriction, for example, okay, you want to transfer some of the cash from the host country just now to the home country. Okay, so they will have the repatriation restriction, the tax rules, okay, labor laws, and this risk is very, very significantly from one country to another. It depends. For the country, especially for the developed country, maybe the political is already stable, so the political risk is not that extreme. But for some country, okay, for example, we are talking about the communist country, so the political risk can be extreme. Okay. The second risk is the economic risk. This is the risk that is associated with the economic factors. Okay. So of course it will impact on the cash flow. For example, host country economy changes. Okay. So for example, let's say we are talking about let's say the host country is Indonesia. So the Indonesia economic change a lot. Of course, it becomes the risk for our parents company. We also talking about the inflation, okay, this is the economic risk. Is the most significant risk that will give impact to the cash flow. And this economic risk, why we said is the most significant risk, because the economic risk will affect the local population purchasing power. So let's say we are talking about, let's say the host country is Indonesia, and it has higher inflation, for example. Okay, so of course it will affect the local population purchasing power. So it will affect the performance of our subsidiary company. It's also impact the business overall cost structure. Okay, and also of course we are talking about costs associated with manager time and effort to respond to the inflation. Okay. The last risk is the financial risk. How the financial risk give impact on the cash flows? We are talking about the changes in the currency value. For example, Malaysian ringgit is lower, for example, lower than US dollar. So of course it will impact on the value that we receive from the host country. Okay, the interest rate. Yeah, why? Because interest rate, we are talking about the interest rate will affect the future cash flow, and other financial factors. We also talk about the foreign exchange risk. So this is we are talking about because we are talking right now in the international setting. So when we're talking about the international setting, of course we deal with the foreign currency. So the foreign currency or foreign exchange is important component of the financial risk. Okay, the foreign exchange will affect the evaluation of project based on the host country cash flow. Okay, when their revenue, so the host country, our subsidiary, let's say in Indonesia just now, okay, the host country cash, so the subsidiary will send money to our parents in Malaysia. So of course, with the changes in the foreign currency just now, for example, foreign exchange, okay, the changes in the foreign currency, the value of the money that's sent from subsidiary from the host country to the parents will become lower. Okay, and of course we are talking about, let's say we are talking about our subsidiary is in US. Okay, when US rate is higher than Malaysia, increase compared to the ringgit Malaysia. So when we send the investment to our subsidiary, okay, of course, okay, this is, we are talking about parent country cash flow. Of course, we have to send higher value, okay, because of the exchange risk high just now. Okay, so this that is the 3 risks that associate with the cash flow. So the next topic is how do we evaluate of the foreign project. I believe when you learn the financial management, you already learn how to evaluate project. So we will do the same things here, except in this topic or in this course, the setting of the business is the international setting. So that is the only difference. So when we are talking about the evaluation project, we are talking about evaluation of foreign project. Okay, we didn't just evaluate A and B, the one that you learn in the financial management, but we also take into consideration all the factors that involve in the international setting. Okay, so when you evaluate a foreign project, there are few, we are talking project. So what is the project? Project, if let's say you consider a new investment in the foreign country. So let's say Malaysia, M is Malaysian company, is consider a new investment in China. So this is what we call as evaluation of foreign project. So you have to evaluate the project. So what is the factors that you should consider? Either you want to invest or not. Okay. So first, you have to look into 2 perspectives. One is in the perspective of the project itself. Okay, on the project itself. Okay. Another one is in the perspective of the parent's company. Okay, just now we are talking about the project perspective. We just ignore the parent's company, but the second perspective is we are looking based on the parent's company perspective. Okay, for the project perspective, among the factors that should be considered is the taxes of the host country, okay, rate of inflation, and of course the political risk. But for the parent's company perspective, there are few things that you should consider. One is form of cash that remains to parent's company. So let's say just now, you consider to do the investment in China. So when you do the investment in China, you will have a subsidiary in China. Okay, so this is parent's company in Malaysia. So just now, when you do the project perspective, you just value either this project in China, okay, can be accepted or not. So this is the one that you do in the financial management. Okay, but if you look on the parent's company perspective, the factors that you should consider is, one is the cash that inflow from the host country. Okay, you will look the cash flow from subsidiary to the parent's company. okay, form of cash remittance to parents company. Number 2 is expected changes in exchange rate. Of course, because you are deal with the foreign country, so of course the exchange rate will be changed. Okay, so we will look on the expected changes. So for this one, the over project life is very important. So for example, you are talking about 10 years project. So 10 years project, you have to project, okay, the changes in exchange rate for the 10 years. Okay, and lastly, of course, you have to look also on the political risk. Okay, so the political risk, among the political risks that you should look is, for example, we are talking just now, the policy of the remittance money from the host country to the home country. Okay, so there are two ways to incorporate factors. One is incorporate factors into estimate of expected future cash flow. So when you calculate the expected cash flow, you have to incorporate all these factors. Okay. Number 2, you can increase the discount rate to compensate for extra risk of foreign investment. For example, let's say the normal rate is 15%. But since you deal with the foreign currency and the foreign currency is sometimes it's unpredictable. So this is among, we said, the most important, the main component risk in the financial risk. So in order to compensate for this extra risk, you increase the discount rate from 15%, maybe go to 18%, for example. Okay. Okay. Sorry. Okay, we end our part 2 here. We will continue this topic to the part 3.